Every market cycle creates its own mythology. Simple rules, catchy slogans, beliefs repeated so often they harden into truth. Buy low, sell high. Diversification guarantees safety. Great investors predict the future. These ideas spread not because they are accurate, but because they are comforting. Yet when financial celebrities, those who survived multiple cycles, crashes, and manias reflect honestly on their careers, they dismantle many of these myths with unsettling consistency. The first myth to fall is the idea that successful investors are exceptional forecasters. From the outside, financial celebrities appear prophetic. They seem to anticipate crashes, booms, and turning points with uncanny precision. But their own accounts tell a humbler story. They were rarely right about when. They were focused on what could not last. Books reveal that the most respected investors did not win by predicting the future, but by preparing for multiple futures and ensuring survival across them. Another deeply rooted myth is that higher intelligence leads to higher returns. Markets reward discipline, not IQ. Financial celebrities repeatedly emphasize that analytical brilliance often becomes a liability. It creates overconfidence. It encourages complexity. It seduces people into believing that every problem can be solved with more information. The investors who endured learned to distrust their own cleverness. They simplified. They slowed down. They designed systems that worked even when their thinking was imperfect. Diversification, often presented as an automatic shield, is another belief quietly challenged. While spreading risk matters, celebrities warn that diversification without understanding is merely confusion. Owning many things does not guarantee safety if they fail together. True risk reduction comes from understanding correlations, incentives, and fragility, not from counting positions. This myth persists because it feels prudent while requiring little judgment. Another popular misconception is that volatility equals risk. Financial celebrities draw a sharp distinction. Volatility is visible, risk is permanent loss. Markets move constantly, but capital is destroyed rarely when leverage, concentration, or structural weakness is involved. Investors who fear volatility often sell at the worst times. Those who fear fragility build portfolios that can absorb turbulence without panic. Many myths also surround timing. People believe great investors know when to enter and exit perfectly. In reality, celebrities describe timing as the least reliable tool in their arsenal. They focus instead on price relative to value, margin of safety, and patience. Being approximately right for a long time beats being precisely right once. Timing myths persist because they promise control in an uncontrollable environment. Another myth concerns information advantage. It is widely believed that professionals win because they know more. Financial celebrities disagree. They argue that information is abundant and often useless. What matters is interpretation and restraint. Knowing what to ignore is more valuable than knowing more. The books show that many legendary investors limited inputs deliberately to preserve clarity. There is also a persistent belief that successful investors are emotionally detached. In truth, they feel fear and doubt intensely. The difference is not absence of emotion, but behavior under emotion. Celebrities emphasize routines, rules, and pre-commitments that prevent feelings from dictating action. Emotional mastery, not emotional absence, separates durability from disaster. Another damaging myth is that risk decreases as wealth increases. In reality, scale introduces new risks. Larger portfolios are harder to maneuver. Public scrutiny increases. Ego stakes rise. Financial celebrities describe becoming more conservative as wealth grew not because of fear, but because enough had been built to lose meaningfully. This runs counter to narratives that portray wealth as license for aggression. The myth of constant activity also collapses under scrutiny. Many believe great investors are always doing something. In fact, inactivity dominates their careers. Waiting, watching, saying no. Books highlight that boredom is not a side effect of investing, it is the job. Action feels productive. Inaction preserves capital. This truth is psychologically difficult. which is why the myth survives. Another widely held belief is that markets reward hard work proportionally. Financial celebrities reject this. Effort matters, but outcomes are nonlinear. Luck plays a role, timing plays a role. Survivorship bias distorts stories. Recognizing randomness keeps ego in check and risk contained. Those who believe success is fully earned often overextend to prove it again. Perhaps the most dangerous myth is that there is a single right way to invest. Celebrities' paths differ radically. Some focus on value, others on trends. Some concentrate, others spread. What unites them is not strategy, but alignment. They chose methods that fit their temperament. The myth of universality fails because investing is personal. A strategy you cannot stick with is not a strategy, it is a liability. Another illusion concerns certainty. Investors crave confidence. Financial celebrities cultivate doubt. They expect to be wrong frequently. This expectation does not paralyze them, it liberates them. When wrongness is accepted, risk can be sized, losses limited, and learning accelerated. The myth that confidence equals competence leads many to hide mistakes until they become fatal. As these myths fall away, a different picture of investing emerges. One less heroic, more patient, less predictive, more resilient. Financial celebrities did not succeed by mastering markets, but by mastering themselves in environments designed to provoke error. And this is where the story begins to narrow. Because once we stop treating investment myths as harmless simplifications and start seeing them as behavioral traps, the question changes. It is no longer which strategy is best, but which beliefs quietly sabotage long-term survival. It is at this point where illusion gives way to discipline that real investing begins, not with bold predictions, but with the quiet removal of false certainty, stripping away comforting stories until only robust principles remain, capable of surviving uncertainty, boredom, criticism, and time itself, unfolding gradually and irreversibly, like a mental filter that removes illusion before it removes capital. And this is where the debunking of investment myths reaches its most practical conclusion, not by replacing old beliefs with new slogans, but by stripping investing down to what actually survives reality. In the second half of these reflections, financial celebrities converge on a sobering realization. Most investment mistakes are not technical. They are psychological repetitions of the same myths played out under different market conditions. The myths change language, but the behavior remains. This is why experience matters more than theory. Theory explains markets. Experience reveals human weakness inside markets. One of the clearest lessons to emerge is that certainty is the most expensive luxury in finance. Financial celebrities describe certainty as intoxicating precisely because it feels like safety. When a narrative feels obvious, risk feels low. When everyone agrees, dissent feels unnecessary. Yet almost every major loss they recount began with consensus. The myth that this time is different survives because it flatters intelligence and dismisses history. Those who endure learn to treat unanimity as a warning, not a comfort. Another myth quietly dismantled is the belief that complexity equals sophistication. As portfolios grow, instruments multiply, and strategies stack, investors feel advanced. Financial celebrities often describe this phase as the most dangerous. Complexity obscures accountability. It hides leverage. It diffuses responsibility. The investors who survived multiple cycles eventually simplified, not because they knew less, but because they understood more. Simplicity, in their words, was not ignorance. It was risk control. The myth of constant optimization also collapses here. Many investors believe they must always improve returns, adjust strategies, chase efficiency. Celebrities argue the opposite. The greatest gains often came from not changing what already worked. Over-optimization introduces fragility. A good system, left alone, often outperforms a great system constantly adjusted. Patience becomes a competitive advantage precisely because it is uncomfortable. Another illusion concerns adaptability. While flexibility matters, constant adaptation can signal lack of conviction. Financial celebrities learn to distinguish between signal-driven change and anxiety-driven change. Markets provide endless reasons to act. Very few justify it. Knowing when not to respond became more important than knowing how to respond quickly. The myth that losses must be avoided at all costs is also reframed. Losses are inevitable. What matters is size and recovery. Celebrities speak candidly about losing money, often publicly, sometimes painfully. The difference was containment. Losses were anticipated, budgeted, and survivable. This mindset transforms loss from trauma into tuition. Those who fear losses excessively often take hidden risks to avoid visible ones. Another belief quietly dismantled is that reputation follows performance. In reality, reputation follows narrative. Financial celebrities learned that being right is insufficient if you cannot survive being early, wrong temporarily, or misunderstood. This realization shapes how they communicate, size positions, and manage expectations. They do not seek validation, they seek longevity. The myth of independence also softens under scrutiny. While thinking independently matters, isolation is dangerous. Celebrities describe building small circles of dissent people who challenge assumptions without competing for attention. Independence without feedback drifts into stubbornness. Feedback without independence collapses into consensus. Balance here is subtle and essential. Perhaps the most important myth that dissolves is the idea that investing skill can compensate for poor life design. Financial celebrities describe moments when returns were high, but life satisfaction was low. Stress, obsession, and identity fusion eroded judgment. They learned that personal stability is a prerequisite for financial stability. A calm life produces calmer decisions. This is not philosophy, it is risk management. As these myths fall away, investing stops looking heroic and starts looking repetitive. The same principles applied over long periods, the same mistakes avoided consistently, the same discipline maintained when it feels unnecessary. Financial celebrities did not win by discovering secrets, they won by refusing to forget what mattered. And this is the true ending of the story. Investment myths persist because they simplify a complex world. But those who endure learn that simplicity built on truth outlasts simplicity built on comfort. The real edge in investing is not superior prediction, speed, or brilliance. It is freedom from illusion. If this reflection resonated with you, pause and ask yourself one question. Which belief about investing feels most reassuring to you right now? That belief is worth examining first. Share that thought. And if you want to keep dismantling the quiet assumptions that shape money, risk, and long-term outcomes, stay connected. Subscribe, follow, and return. Because the most powerful advantage in markets is not knowing more, but believing less of what everyone else repeats.